Good morning and welcome to the i3 webinar on inflation volatility, co-hosted with Ruffer LLP. I'm Tech 10 with i3, and I'm pleased to have Alex Lennard join us today from Ruffer's London office. Welcome, Alex.
Thank you for having me, Tech.
Alex, a bit of background on Alex. He's an investment director at Ruffer LLP. He currently sits on the Senior Asset Allocation Committee and is co-manager of two of Ruffer's flagship funds. Now, in preparing for today's webinar, I was doing a bit of a background reading and chanced upon this old quote. They often say inflation is like a big old ketchup bottle. You try and try to pour, and it doesn't come out. Finally, you lift it up, put your eye to the spout, and it explodes all over your face. In other words, it's hard to see inflation until it's too late. Well, maybe not so this time, because the writing is already on the wall. We recently did a straw poll amongst institutional investors, asking respondents to indicate which was the more likely scenario in the coming year: moderate inflation, high inflation, deflation, or stagflation. Unsurprisingly, high inflation had the most votes, but mind you, stagflation was creeping in too. So the return of inflation volatility represents probably the most challenging and significant paradigm shift in decades. Asset owners are going to have to look harder to find protection, as the last 20 years of optimization will have to give way to resilience. What exactly is resilience? And we'll cover that in a moment. So in this webinar, Alex will look at why old habits must be broken, what new ones need to be formed, and how Ruffer are reimagining the art of portfolio construction. So we'll address this topic in two broad headers: inflation scenarios and the associated volatility, and secondly, and probably more importantly, implications for portfolio construction. Now, in terms of format, this will be a short presentation followed by Q&A for a total of 40 minutes. I'll encourage you, the audience, to submit questions via the question box, and we'll endeavor to answer them in the course of the conversation. This webinar is for educational purposes only. It does not constitute financial advice. It is intended for wholesale and institutional investors only. I will now ask Alex to share his perspectives with us. Alex, over to you.
Thank you very much, Tech. And as Tech's described, the basis of my presentation today is that we are moving into a new regime, one that is going to be characterized by greater inflation volatility, one that will be more turbulent for markets, asset allocators, and investors. Now, it's worth noting I pulled all of this together prior to the dreadful events that we're seeing in the Ukraine at the moment. I have no insight into Vladimir Putin's next step, but what I can say is the events that we're seeing at the moment are only likely to act as an amplifier to trends that were already deeply embedded. So in order to look back, to make the points, first I'm going to have a look back at the previous regime. Then I will discuss why we believe the world is changing. And then, and most importantly, why does it matter? So a quick look back at the previous regime. This was kick-started at a time that inflation was rampant, debt and asset prices were low, and none of these seemed likely to change. Paul Volcker came to the Fed in 1979, shortly after giving a speech titled "The Political Economy of the Dollar," in which he promised to slay the inflationary beast by controlling monetary aggregates. Ultimately, he was successful, catalyzing a regime of low and stable inflation. Now, it's worth noting he got some extraordinary help. China joined the World Trade Organization, the Soviet Union collapsed, huge demographics such as baby boomers and women joining the workforce, and of course a technology revolution. All of this summed up to a heavily deflationary environment, here illustrated by the price of a quality adjusted computer. This is the Ice Age, an era where the supply side of the global economy has been refrigerating inflation and putting downward pressure on prices. This is something we describe as an intertemporal disequilibrium. Now, in reality, these are just long words to describe the successive bringing forward of future demands to today. Consider a really simple schematic. You have a positive supply shock emanating from China. This drives lower inflation, and then rates fall, borrowing is sped up to spend on asset prices. There's greater financial intermediation. The inevitable excess that follows led to policy tightening, a financial crisis, and then a central bank response brought about by the threat of deflation. Rinse and repeat. The net effect is that nominal and real interest rates ratchet lower in a path-dependent fashion. The combination of this dynamic of central banks being focused on inflation targeting, meanwhile China has been exporting deflation to the rest of the world, ensured that the economy and the financial system remained in refrigeration mode, ensuring interest rates and inflation remained low and stable, elevating all asset prices and, importantly, making asset allocation incredibly straightforward, as bonds and equities were negatively correlated. Now, that was the previous regime. In our view, the refrigerator is now about to become a heat pump. Many of these deflationary forces are one-offs that cannot reoccur. So the supply side of the economy cannot and will not be as deflationary going forward. And this is at a time that the management of the demand side of the economy is changing. We can see politicians are taking a greater involvement in financial markets. Programs like quantitative easing were supposed to be one-time things, but they seem to be becoming permanent. Governments are going to decide the winners and losers in the economy. And governments are increasingly tilting the scales away from capital and towards labour. The key point here is the lines of monetary and fiscal policy have become increasingly blurred. Central banks, once independent, have become tools of government, a big amorphous policy-making body. Nowhere is this clearer in the cast of characters. Christine Lagarde, head of the European Central Bank, was a politician and is now a central banker. And Janet Yellen and Mario Draghi, you have central bankers turned politician. And perhaps most telling of all, as Tech alluded to, is the return of inflation into the public consciousness. Not long after Bloomberg Businessweek declared it to be dead, it is now central to the policy-making debate and on the front pages of most newspapers. Now, longer term, we are confident that after 40 years, the tide is unequivocally coming in for inflation. But if you think about what happens on the shoreline when the tide comes in, hour by hour, it gets higher. But there are points between the waves when the sea looks like it's retreating. And this, we think, is the perfect metaphor now for inflation. Not a straight line higher, but a lot of volatility ahead. Now, when most people think about inflation, they think about the 1970s, driven by an oil price shock. But perhaps today we think a better comparison is the immediate post-war period, highlighted by this chart showing CPI. Just like now, you had supply shocks, huge borrowing, and large swathes of the labour market returning to work. And the experience then was not just higher inflation, but first and foremost, higher inflation volatility. Big spikes followed by large drawdowns. The impact on markets is similar, but it's not the same. With volatility, it's pretty much impossible to time the bottoms and the tops. so you cannot afford to back just one view. Portfolio positioning will have to reflect the fact that the journey is not smooth, and investing solely for an inflationary endgame could be uniquely wrong at times on the way. Now, that being said, we all know the Fed are going to raise rates, that they are worried about inflation. Their dual mandate that requires full employment and stable prices has been met on both cases. QE is being withdrawn, and asset prices are going to be scheduled to stop pretty soon, just as interest rates are likely to rise. Now, many commentators are worrying that this is going to be a policy error, particularly at the time of stagflationary threats. However, in our minds, the policy error has already been made. After 2 years of overly accommodative fiscal and monetary policy, the tightness in the labour market is already well and truly evidenced, with even low-skilled workers and low-skilled jobs now being forced to offer a signing-on bonus. This is indicative that higher inflation, which is always a behavioural phenomenon, is already embedded in the mindset of workers. And just to see that in chart form, what you can see is that there's been a step change in earnings for individuals. And this is evidence across sectors, where wage rises have gone from around 2.5% per annum to nearly 7%. Now, there's definitely truth to Friedman's assertion that inflation is always a monetary phenomenon. But the reality, as Volcker's speech in '79 made very clear, is that the reality is inflation is always a social phenomenon. So you have inflation pressure coming in from higher wages. And at the same time, the Chinese deflationary pressure on costs of goods is abating. Here we're showing the price of goods in the G7, which has been deflating by between 1% and 2% per annum for over 30 years. These are now rising sharply, and in fact started to rise a good few years before the pandemic and before Russia's invasion of Ukraine. All told, this adds up to an environment where inflation is going to be rising sharply and policy and financial conditions are going to need to be tightened equally sharply. So why does it matter? First and foremost, inflation volatility and bond volatility are bedfellows. Here in the blue line is the volatility of US CPI over the last 60 years. And the green line is 10-year US Treasury volatility. First and foremost, what you can see is the impact of inflation volatility will almost certainly lead to a greater bond market volatility, or perhaps more likely, greater term premium, at a time that markets and financial market participants have been conditioned to a persistent term discount. So why the shipwreck? What I'm showing here is a picture of the Torrey Canyon. The Torrey Canyon was a shipping boat that crashed into the coast of Cornwall in 1967, spilling 30 million gallons of oil into the sea. Now, why did that happen? Despite fierce cross currents and volatility of the oceans, a narrow thoroughfare, and a set of very out-of-date maps, the captain decided to stick to his original route. He had a tight schedule to keep. Now, like many financial market participants, the captain was experienced and well seasoned, but unfortunately he and they are still human. And as you know, the human brain is not always rational and can suffer from errors of judgment, or perhaps in most cases, cognitive bias. In this case, The problem came from the captain's inability or unwillingness to change course, even though there was mounting evidence he should consider. So what's my point? Markets are undoubtedly facing obstacles, and the cross currents in the form of the recovery from the virus, geopolitics and policy making are strong. Not to mention the fact that investors are relying on the same set of maps that they have done for 40 years, investing for an environment of falling yields and inflation. If the tide has turned, we worry that investors neither have the foresight nor the tools to navigate the rough waters, and their maps will suddenly become very out of date. So we're not alone in pointing out that there may well be troubles ahead, but as we've said, there seems to be an unwillingness to change course. Bob Dylan had it right when he said, "We've all got to say it to somebody." For the captain at the time, a detour would have meant the late delivery of goods. For asset managers, they would be foregoing upside, an unforgivable crime in a world that has become intolerant of underperformance. Perhaps even more so in a world where you've got your super, your future legislation dictating asset allocation. The trouble for investors is perhaps most evident in the bond market, where duration, as we're illustrating here, or sensitivity to the price of interest rates is at an all-time high. In simple terms, the amount of capital at risk if term premiums and bond yields were to rise is as large as it's ever been. And this is also true of equity markets. What I'm showing here is the chart of modelled equity market duration, currently at 55 years. It's only been higher during the dot-com bubble. Now, the dominance of passive investing has been the logical corollary of the refrigeration mode we have been in. There have been bumps along the way, but equities have always been saved by successfully lower nominal and real interest rates. If we are switching to the heat pump mode, like we think we are, risk premia are going to expand as nominal interest rate volatility remains persistently high. So equities will lose the real re-rating tailwind they have enjoyed. What this means is equity markets are perhaps even more intolerant of inflation and interest rate volatility than the bond market. Now, despite this obvious risk, a lack of attractive alternative means investors are forced to stay at the party. Here we show the results of an experiment to see how investors change their portfolio allocation in response to changes in risk-free rate. At 5%, they allocate about 60% of their capital to risky assets. At 0, this is nearer 70. What this means is that as rates rise and volatility rises, they will be forced to reduce risk, probably into falling markets. The captain of the Torrey Canyon apparently pleaded that he only needed 30 more seconds. The same might be true for risk takers today. Here is a famous quote from John Maynard Keynes: "When the facts change, I change my mind." And this seems to be the moniker that many investors are operating with. They appear confident they can change their approach in time to avoid troubled waters. The trouble is, this is a bit like waiting for a punch from Mike Tyson. We think it's a mistake, and it's much more prudent to prepare for inflation volatility and tighter financial conditions before they become embedded. So what does this mean in practice? Investors are going to need to be willing to change tack quickly and in advance. Holding a single strategy will lead to certain failure, and investing for inflation volatility is very different from investing from a solely inflationary outcome. Hedges, these need to be paid for. This might mean giving up some upside if you are to build a truly anti-fragile portfolio. Cash might at times be king, It's an unequivocally uncomfortable asset to own in an inflationary world, but we think it's an essential one, storing up portfolio arrows needed to pick up opportunities. And I fervently believe we are moving from this world of into a world of this greater inflation volatility. And in contrast, the last 20 years, optimization, which amplifies vulnerability, will need to give way to resilience. I'm going to pause there and hand back to Tech to take some Q&A.
Thank you very much, Alex. And we'll get back into the portfolio construction implications in a moment. I think that's important, but I thought it'd be good to sort of take a step back a bit and look at that macro environment. And while I'm posing a laundry of list of questions for Alex, again, I'll encourage you, the audience, to input your questions in the box, and we'll try to answer them in the course of the conversation. Now, Alex, again, back to I guess that macro level, I get the sense that the inflation discussion or commentary has moved beyond somewhat that one-dimensional sort of thinking, where is it transitory, is it structural? I think we're way past that. There's a whole myriad of different factors, and to your point, unfortunately, the conflict in Ukraine and so on are exacerbating the current scenario. I saw commentary out there recently where it's bringing geopolitics into the fore now, without trying to speculate what the outcome and what will be. I think it's probably useful to talk about the spillover effects of geopolitics. In your slide, you had interestingly mentioned how central bankers have turned politicians and vice versa. And so the commentary I saw was, does the Fed face, we talk about the trade-off between growth and inflation, which has been ongoing. Is that really the question? Or is this more a trade-off between what would say national security in the form of geopolitics? So we're talking increased sanctions against Russia, because frankly, it has to increase a few more notches before there's any impact there. And if so, if you think about the trickle-down effect, more inflation, supply chain disruption, inflation gets down to household in terms of energy prices. I think, if I'm not wrong, your government has already been looking at using fiscal policies in subsidies, so that in effect, I would say, probably fuel the inflation environment. Is it something to think about as well?
Yeah, I think definitely it's, if you think the demand side of the economy for the last 4 decades has been entirely managed by economists and central bankers, and other than inflating a huge debt bubble, they've actually done a pretty good job managing that demand side of the economy. Now that you have had 2 successive crises that have really proven that monetary policy has slightly run out of road and seen the baton passed from central banks to governments, I think what you will see is much more activist fiscal policy, and policy directed more at the man on the street rather than necessarily at the financial economy, to try and avoid recessionary conditions. That does to us mean that you're more likely to see inflationary conditions. And I think the one thing we can say about governments is they're probably not the best allocators of capital, that they are almost certainly likely to be amplifiers of trends that you're seeing already. Just coming back to your question, your first part of your question on geopolitics, what has been the big deflationary force for the last 4 decades has been, you could sum it up as globalization. I specifically talked to China, but the reality is you've had an increasingly globalized economy which is focused on just-in-time supply chains. We now think you're moving into, you've probably seen that peak globalization, and you're moving into an environment where people are looking for just in case. Now, prior to the awful situation in Eastern Europe, that was just in case from a supply chain perspective. Now it's just in case in terms of energy security, food security, infrastructure spending. All of these things are inflationary in nature, and these are big tectonic plates that once they start shifting, take a very long time to put back into place.
Thank you, Alex. There's a host of questions from the audience, so I'm going to go very specific here in terms of the presentation. So question here is, the real question is, will yields go to real returns, or will the bond market continue to accept negative real rates?
I think the bond markets are going to accept negative real rates. The reality is all of the situation we're in at the moment is because there's too much debt in the world. And like many things, this part of the solution for a debt problem was created by accident by the British. We're very good at creating very good mechanisms by accident. And if you look back to 1973, Britain was reliant on a loan from the IMF. We had too much debt and we couldn't afford to pay it. 8 years of inflation later, and importantly, inflation held above the prevailing rate of interest, so negative real interest rates. We were debt free and able to enjoy the Barber boom of the 1980s. Now that's the model that we're following at the moment. The world is being financially repressed. Just no central banker can stand up and say we're trying to financially repress you.
Thank you, Alex. There's quite a few questions, so I'm going to fire off very quickly and we can cover it off. So you say that price inflation will be volatile, but will wage inflation also be volatile? I believe wages are sticky, so not volatile. Does this matter that price inflation is volatile and wage inflation is not volatile?
So I think wage is the most important component, and I think the question's right. Wages are sticky. I think what we mean by inflation volatility is it's not going to be a straight line. It's going to be something like a bullwhip. So there'll be periods when it will look like you're heading towards quite stagflationary, hyperinflation type conditions, and then inflation could come crashing back down. So particularly if it's commodity prices falling on any de-escalation. So structural trends, things like wages and cost pressure coming out of China, for example, but around that you're going to see a lot of volatility.
Right. Next question relates to measurement. So the measurement of inflation volatility, should the focus be inflation expectations rather than realization? And if so, how might you gauge volatility of inflation expectations?
I mean, I think inflation expectations are the key thing, and I'd slightly challenge your comment, Tech, that the sort of transitory versus structural debate has been solved, because long-term inflation expectations have remained really quite anchored through the course of this year. I think if you think what is a break even in its simplest, which is market expectations for inflation, it's current inflation, people's future expectation for that level of inflation, and how certain will they be about that future expectations. When there's more short-term inflation volatility, that will directly feed into greater uncertainty at long-term inflation expectations. So one feeds into the other. It's a bit like sort of the VIX curve, for example. When you get a spike up in the VIX, the front end moves the most, but then the whole curve shifts up afterwards. And I think inflation volatility works very similarly.
Sure. The next question, I guess, relates more to, in a sense, I might ask you to define inflation volatility. So it's around, investors care about inflation. Should they also care about inflation volatility? I mean, is the trend or level most important, and volatility just an annoyance? And another question, which I might lump this together. So do you think the volatility of inflation is just the primary headline, or also core inflation would demonstrate a proportionately similar increase in volatility as well?
So I think one leads to the other. I think inflation volatility leads to higher inflation. Why it's not an inconvenience, and it's the chart I showed up that showed inflation volatility versus the volatility of treasury returns. If you get inflation volatility, that means there's more uncertainty as to what that long-term interest rate needs to be. So more term premium in markets. And that's what really matters, because and why it matters is because bonds and equities become positively correlated and are probably both falling at the same time. So any regulator that's telling you to put your portfolio into a balanced portfolio of equities and bonds is probably carrying out some significant moral hazard at the moment.
Thank you. Now, a couple of questions here that relates to portfolio construction. I might just hold that back a bit because I think, Alex, you've got a few more comments on there. But final question, this is on equity duration. So the lengthening of equity duration is stark. Now, does this reflect the composition where company cash flows are backloaded, where realization of net positive cash is much longer than historically? Interestingly, the debt profile of IG indices has lengthened. A different company core in these indices?
So the first chart was on duration. That's purely looking at corporate and investment grade duration in the US. The picture in Europe is very similar. The wise equity duration gone up so much? It's because of the dominance of tech and profitless tech, which is ultimately this is growth in the future. So longer term cash flows. So your equity market has become more sensitive to higher rates.
Right, interesting. Alex, I might pause here. There are a couple of questions. I mean, there's one on practical examples relating to resilience over optimization and implications for portfolio construction. I might leave it there for a moment. I might ask you to go back to your slides and cover a bit on what are implications for portfolio construction.
Sure. So just checking that you can see that tech.
Yes. Yeah.
Perfect. So these are essentially the 4 rules that I think you're going to need to follow by. So be active, be willing to give up some upside to pay for protection, tactical use of cash, and resilience over optimization. Now, just three examples of what that means within our portfolios and what we think is important. The reality is some of the trends that have been in place for a long time, particularly around ESG, have meant structural underinvestment in certain sectors. Now, in a world where demand remains strong and energy security and food security is going to be more important, owning sectors that potentially have become more and more uncomfortable and seeing structural underinvestment could create huge potential for returns. So whilst the story that I presented was definitely bearish in nature, there will be huge opportunities to make money. Now, most importantly, it's about going to be paying for protection. So paying for protection against vulnerable areas of credit markets. So from our portfolios, we have no exposure to credit at all. But what we do have is a lot of exposure to credit default swaps and a willingness to pay premium away to get that protection. Now, what we're showing here is the yield on CCC bonds. Now, we used to call this junk, but we're now very polite, so we refer to it as high yield. This also has a negative real interest rate. It's not even compensating you for inflation. So at Ruffer, we often talk about getting the other side of a mania. This is the biggest mania that we can see. So if you can own credit default swaps, or as we have done in the past, being willing to buy call options on the VIX, we think this is a real way to get protection into portfolios. Now, it does mean giving up some upside, but actually, if that allows you to build true anti-fragility into portfolios, we think it's going to be an essential tool in the armory. And as I've sort of said, and it's as hinted at with the question around wages, the end destination is definitely going to be one of continued financial repression and higher inflation. Now, to our minds, the assets that you're going to want to own for that are inflation-linked government bonds and real assets such as gold. Now, you're going to have to be quite careful in managing duration risk. So we are specifically trying to own two convex assets, the inflation-linked bonds, and combining them with interest rate options that bring our duration down to negative territory are going to be keys. But protecting against inflation and identifying an asset class that we think people will panic into once inflationary fears become embedded will be key. So those are just three examples that we think are going to be important in terms of driving returns. But I think having that active view and willingness to own positions in your portfolio that might be unequivocally wrong at times will be key. This is the antithesis of risk parity or CTA strategies, which have all been reliant on optimization and an ability to rely on that negative bond equity correlation that we just don't think you can anymore.
Thank you, Alex. In fact, I think you have answered the question where it talks about, the question here is, can you provide more practical examples on your point, resilience over optimization?
Yeah. So one is definitely willingness to pay for protection. So I talked about credit default swaps. The other area that we've been using actively recently is put options on areas of the equity market that are potentially most vulnerable to liquidity withdrawal. So we've been able to do some analysis to try and identify the specific equities that have benefited the most from retail and passive flow. So if you get tighter consumer balance sheets and tighter liquidity, areas that will be potentially most vulnerable in the event of liquidity conditions tightening. Now, that was the second tier of the NASDAQ, the profitless tech, and I think it now has potentially moved to some of the FANGs as well. So basis risk is another thing that you're, because you don't want to have a portfolio that hedges out all risks and ends up with a zero-sum game. So you're going to need to take on basis risk and have a hedged portfolio.
I recently saw a headline in the Wall Street Journal, so I thought I might get your comments, and the headline reads, Bitcoin, gold, and oil are all having a moment, but the best haven for ordinary investors might be long neglected value stocks. Comments?
I'd probably agree with that. I mean, what value stocks have essentially been starved of capital or their industries that have been starved of capital for quite a long period of time. So if you're going to get demand increases and greater reliance on that sort of what you referred to earlier as that sort of domestic biases over global biases, value seems very well. Ultimately, it's a short duration asset. So energy, financials, defense, pharma, things that potentially have been starved of capital, I think could actually look really interesting in terms of driving returns. I mean, Bitcoin, we have used it in the past. I think it's probably too speculative at the moment, and it's probably too dependent on retail balance sheets. But gold and energy, definitely.
It's a question here from the audience. So holding an options position, although appealing, can be expensive in the long term. Should one look at using derivatives actively or passively, so buy and hold? I think this speaks again to your comment about resilience and anti-fragility.
So I think it's active, and you want them to be. Again, you can't hedge out every risk with derivatives because then it will be too expensive. You need to find cheap, congruent, and potent hedges. So, for example, we have used the VIX in the past. We don't think it's cheap enough at the moment, but I think what it's going to require is some bravery and the willingness to say, even if you're receiving pressure externally, know if the right thing to do to pay for some protection versus seeing my members lose huge swathes of capital if bond markets and equity markets derate at the same time.
Thank you very much, Alex. We've sort of come to the close of the session, but there's a final burning question from the audience. You've shared, the history, what's going on now, and your prognosis of what we think will happen. What's the chance that your views are wrong? Have you thought about you being wrong in terms of what you've shared so far?
So, I mean, I think it's something in Ruffer's DNA, in that we always ask ourselves, what if we're wrong? That we do have a slightly different approach to risk, in that instead of trying to maximize returns, we're always asking ourselves, well, what if we're wrong? And if we are wrong, do we have something else in the portfolio that's going to keep us in the game? I think the thing that can continue, I think if Paul Volcker or someone quite similar to Volcker came back to the Fed, I think we'd have to acknowledge that financial repression was not here to stay, and that's a key determinant of our portfolio decision making at the moment. And I think we also have to acknowledge that there are still some pretty deflationary conditions out there as well, namely technology. I think the difference talks to the response to deflation now. And coming back to your very first question, Tech, which talked about impacts of governments, the last 4 decades have seen essentially money accrue to 2 areas of the economy: shareholders and management of companies, at the expense of governments and workers. Ultimately, the pendulum is swinging back the other way.
Sure.
And to us, that is a direct threat to asset owners and asset managers, and that's why we think it's the most important thing to worry about.
And perhaps I can just sneak in the final question. You talk about technology, and it's the final question here. And so prior to the pandemic, the prominent concern was technology-driven deflation. So what contribution will technology be, going forward? What contribution does technology make?
It's still going to be, it will still be deflationary, but you're not going to get the same level of deflation that you've had from technology for the last 3 decades, and it's not going to be supplemented by the other big deflationary Ds, demographics, globalization, and importantly the emergence of China and the breakup of the USSR. So it is the lone deflationary force left in the world.
Okay. I guess speaking to the topic on inflation volatility, it's a multifaceted dimension in looking at various aspects and not sort of singular, one-dimensional, and hopefully, it just adds to the uncertainty, unfortunately. On that note, thank you very much to Alex for your insightful presentation discussion. I'm sure we'll talk about inflation for a bit more, given what's happening in markets. To our audience, I hope this has been educational, relevant, and practical. For now, stay well, and thank you very much for attending. Bye for now.